Well, good morning, everyone, and welcome to Pureprofile's investor briefing, where we will discuss the company's Q4 results, which were released to the ASX this morning. My name's Jane Lowe, and I'll be your host for today's session. Joining me is Martin Fils, who's CEO and Managing Director of Pureprofile. Good morning to you, Martin.
Good morning, Jane.
Good morning, and also Melinda Shepherd, who's CFO and COO. Good morning, Mel.
Morning, Jane.
Good morning. Okay, so the plan for this morning is that Martin and Mel will step us through the results highlights. That will take about 15 minutes, and then we'll have a further 15 minutes for Q&A, where we'll open the floor. If you're looking for the materials to follow, if you can't see the screen, you can find them on the ASX or on the Pureprofile investor site. If you would like to ask a question, you can do so using the Q&A function in the Zoom ribbon at the bottom of your screen. So type in your question as you see fit, and we'll get through as many as we can in the time that we have. But for now, I'll hand over to Martin and Mel, who will get us on the road. Thank you.
Brilliant. Thank you very much, Jane. And thank you very much to everybody who is joining the presentation this morning or listening to and watching the recording. So firstly, we'll run through a little bit of our business overview. I continue to get phenomenally excited about Pureprofile. It's now my fourth full year of Pureprofile and looking at the full year results for a fourth time, and we've hit another milestone. And the big milestone that we've hit for financial year 24 is our maiden full year net profit after tax of $100,000, and that from a net loss of last year of 1.9 million. So really excited about that. That's been an absolute focus for us as a business for the last 4 years. You know, ever since we did the recapitalization, Mel and I, a key focus, as I said, has been to ensure that we were operating cash flow positive. That's been the best part of 3.5 years now. As a business, we weren't going to do another capital raise to keep the lights on, and that's been absolutely played out. All of the investment that we've done in the business, the technology investment, opening up new countries. We're now in 13 countries from 5 countries 4 years ago. The growth that we've seen year on year, and this year a 10% growth, has all been out of reinvestment in the company. And we've then been able to deliver our net profit after tax and maiden one. So really excited about that. It's a new, as I was talking earlier to Mel, it's a new box that we're going to have to add into the table that everybody's familiar to seeing in Pureprofile, and that moving forward, that is something that we'll keep as a business. So phenomenally exciting, see that growth and see that bottom line growth, it really filtering through as a company. We achieved 10% growth on the year at the top line. So that's achieving our full year guidance of 48.1 million in revenue, 4.4 million in EBITDA, and again really exciting that $5.2 million cash balance, significantly up from the half year and up from financial year 23 as well. So a really pleasing set of numbers in what is a tough economy at the moment for many companies. We're seeing them not achieve guidance. Our competitors, we're seeing not seeing growth. That's a very different story at Pureprofile, with us again achieving guidance, achieving good growth. And where we've seen that good growth come from, again, we've talked to that, our rest of the world revenue up 43%, making 43% of the total $48 million. So again, another focus for us has been growing that international revenue from where it was over 80% Australian-based company. Now 43% is external revenue, much larger market. So really excited about that, and that's up from 38.5% in 23. So hitting all of those key milestones we wanted to do. 91% of revenue comes from repeat clients, and again we're seeing that great service, great delivery, client first mentality as a business, and clients with that high level of quality and high level of interaction with team members. Again, they're coming back for more and more. AI has been a topic for everybody. We've rolled out some internal AI solutions. In actual fact, we rolled out 5 new AI solutions over the year. And where have we seen that filter through? It's about those 3 metrics. Are we faster? Are we cheaper? Are we improving quality for clients? And those are the boxes that we're seeing the generative AI solutions deliver. And those, we'll talk a little bit later about what those solutions are. But it's really having innovation mentality as a business. And so we've, again, managed to do that whilst delivering that NPAT profitability. We've established 2 new offices in the year. So we opened up Spain and Germany, taking us to 13 offices around the world. They're new offices for us, and so we will expect to see that come through in financial year 25 and onwards as we win those new international clients. We were winner of an inaugural Research Partner of the Year award out of Australia Research Society, and again that just rubber stamps why we have 91% revenue repeat from existing clients, because it's about having that client first mentality. And also, why do clients come back? Because they want to work with motivated and proactive consultancy-based team members. And we're named amongst the top 50 inspiring workplaces in the UK. We were 4th place inspiring workplaces in Asia in the year. And I think it's this week, actually, we've got the Australian results and the Australian gala coming up. So again, that real focus on having great people, rewarding great people in the business, giving them the right tools so that they can deliver for clients. So I'm delighted to be able to share this slide with everybody. We also made our first acquisition in 4 years. And again, a couple of things around the acquisition. We were firstly able to do that out of cash reserves, so there's 0 dilution. The acquisition met 3 criteria that we look at for businesses, which is number 1, it's not dilutive to our business. So again, an acquisition that we can make that is at multiples lower than the multiples that we trade as Pureprofile. Think about revenue, thinking about EBITDA. Secondly, where does that fit in within our strategy? So is that enabling us to leapfrog part of our strategy? Is that adding data points to us as a business? Could be new panelists, new data opportunities. Is that adding great new talent to our organization? And then thirdly, where can we achieve synergies? Does that allow us as an organization to be more efficient? And can we make the business that we're acquiring more efficient? And iLink fitted into all of that criteria. The total consideration is $1.25 million, initial tranche, and then a further tranche after 9 months. It's a business delivering circa $2.6 million of revenue in Australia. It's got 50 or so clients, many of whom we don't work with today, even as market leader in Australia. They've got a great panel that we can augment our own existing panel to, and there are great synergies. There's great opportunities for iLink as part of Pureprofile today. Suddenly they have availability to 100 plus operations team members in India and Philippines. They didn't have that before, and they have access to really rich panels in Australia and around the world that they didn't have access to, that they can win more revenue from more clients doing the same thing that they do today. So really excited about that. We're now 3 weeks into that acquisition, and as business, the integration has been great. The work that we've done regarding existing team, working with iLink team, and the 17 people that have come across MyLink are all fantastic. And as a company, they've been around since 2001, and very much the culture in that business, the way that business operated, the way that the founders, Scott and Chris, thought about the business was very much about very similar to our own ethos. So it was a really seamless acquisition to come in. As I said, we did that out of cost, out of cash, zero dilution, and it's all just additive. And when we look forward to financial year 25, which we're now into, we look at growing those revenues, growing the profitability of both companies because of those synergies that we come through. So really excited about that, and it's a great first step, another maiden step for Pureprofile, making that acquisition. We also, towards the end of the financial year, had some really fantastic positive board changes. Great new chair came into the business in Michael Anderson, really strong ASX experience, really strong experience in growing businesses, and chairing growing businesses and those challenges that brings as an organization. I've really enjoyed working with Michael as it's now been a couple of months. And again, Michael based in Southern Hemisphere, same time zone, really important that we've got Michael to run all the board and be a really close relationship with myself and him. And I think we've already built that just in a couple of months. Great also, and to bring in Adrian Gonzalez, who's joined the company. And Adrian had really deep industry experience. He worked at Kantar for a number of years, over a decade, heading up China businesses, then the whole of Southeast Asia and Asian businesses. And that's over 4,000 employees, industry-leading company in Kantar. And again, already in the 8 weeks or so that Adrian's been on the board, it's great to have that sounding board. It's great to have that advice and challenging us. And have we thought about different elements and different opportunities? And so I can't be happier to be able to announce that as we did at the time, and to reinforce bringing Michael and Adrian onto board to what is already a strong board. So that's some great news as well. Not yet reflected in the share price. So as we've seen, continually growing that revenue, continually growing that EBITDA, and now growing that profitability to an NPAT. During that same period, we haven't seen that reflected in the share price. And I think it's really important to acknowledge that, yes, we need to focus on growing a great business, which we're doing. And now it's a case of saying, okay, we've got a really good story here. And the really good story is an Australian company that's gone out and being an international business, with, as we said, that now over 43% of revenue coming from international. So that's a great story. Continual growth is a great story. Profitability is a great story. And now really in 25, leveraging off of those great platforms that we've built, and seeing even further pushing on in UK, US, and other international markets. So we've got that element, and then it's really about us getting out with our partners, the IR department, and really talking to funds and making sure that the word is out about Pureprofile and the opportunities out about Pureprofile, so that we turn that share price around again to really reflect on what is a great, strong, secure business and growing business that we have today. Because what's the prize? And we've talked about this in slides before and presentations before. You know, our global peers, and thinking about some of our global peers, generate between 150 million and $1 billion in revenue. And end of financial year 25, we're at 48.5 million Australian dollars. So we've got a huge amount of headroom there. Why? Because they're really strong in the UK and really strong in the US, and a number of direct to client solutions. So what we need to do, and we've done, but really accelerate that as a focus, is really growing out now that UK business. We've got a strong platform. We've been in the UK for over 8 years now as a business, but we've seen that continual growth over the last 4 years. And now it's about financial year 25, growing out that expansion in the UK and us winning some of that share that our competitors are seeing, that we are easily beating around the world because of our better service, better delivery, better people, and higher quality. Then again, the same for the US. It's an even bigger beast. US makes up 53% or so of our total industry. We're still remote, and it's about thinking about, okay, let's put boots on the ground. Let's actually start to offer directly in marketing. We've trebled the size of our UK business over 4 years. We've trebled the size of our US business over 4 years. But now 25 and then 26, it's really about being serious in the UK and the US, and us growing exponentially in those markets, and being, as we've talked about, the top line, our clients, our competitors, much larger than us, because they do those two markets stronger than we do. We've also got some great tailwinds. There are data quality challenges around the industry. We don't have that same, because the audiences that we build are all permission-based audiences, strongly vetted, really high quality. That again comes back to why the 91% of clients keep coming back to us. Our peer group have business challenges, and we see that we're winning market share. We're winning employees wanting to join Pureprofile from competitors, so that's great tailwinds. And then also the rise of AI. So we talked about those 5 internal solutions that we've built. There are some external solutions in the pipeline. Enables us to be much more innovative, to deliver innovation faster to our business and to externally. And so think about clients, efficiency, new client solutions, faster development. Those are great tailwinds for us as a business. And so with that, I'm going to take a breather, and I'm going to hand over to Mel, who's going to go into a little bit of detail around the numbers.
Thank you so much, Martin. So I get the lovely pleasure of talking through the financials. I just wanted to remind everyone that all the numbers that are included in all the slides that I'm just about to go through with you are preliminary and unaudited, and they exclude the discontinued Pure Amplify Media business units, which we obviously had last financial year, and we had some costs in the P&L through in the first quarter of the year, because we didn't shut it down till August this year, or last financial year. When we talk about EBITDA, we are excluding significant items, and the main thing that we include in significant items are share-based payments. So just reminding everyone of that. Sort of our first point, as Martin pointed out, our first full year. So at the half year, you might recall that we had a net profit after tax of 41,000. For the full year, we have a net profit of tax of $107,000, which is about 100 grand, obviously, with a rounding there, compared to a NPAT loss of 1.9 million. So this is for the continuing business only. If I add in the small amount of the loss for the discontinued media business, we are still in a statutory profit of $95,000. So that's fantastic news. I know we will be putting out the audited results at the end of August. So we'll be releasing our annual report there, and we'll obviously go into more detail on the balance sheet, the cash flow, etc., and all the lovely other disclosures that you will get to see. A few other little points. We do have a little bit of tax expense this year of about 30K, and share-based payments for FY24 were $950,000 as well. So net profit before tax was obviously also profitable from that perspective, even it was only a small amount of tax expense. Full year revenue, 48.1 million, compared to about 43 when we excluded the discontinued business unit last year, which was 10% up. It's been a really lumpy year for us, as many of you know, as you've been following us over the last financial year. We had quite a tough Q2 with a really tough October. And then we saw November coming back, December coming back, and the team have worked incredibly hard to really come up and bring the business performance back up, particularly in Australia, which has been more impacted than the rest of the world. And we had actually a record quarter of Q4 of 13 million. So that's the highest revenue quarter that we've had historically. So, and that was 18% up. We'll get to that slide a little bit later, which is absolutely fantastic. And, you know, Martin and I are so proud of how hard the team has worked in a really challenging environment at the moment. So basically 10% up from a revenue perspective. Our ANZ business was 2% up. I'll talk a little bit about ANZ. So we did see that in Q2, our ANZ business was flat. Q3 was 1% up, and then for Q4 was 7% up. So you've really seen that business performance picking up during the last 9 months. Our rest of world business up 23%, so pretty consistent with what you've seen. That business has been performing incredibly well over the last 12 months and even prior before that. And that's really where we've been putting our investment. EBITDA is down 4%, but that's because you might recall we made a change to our short-term incentive program where previously it was equity-based. So, it was booked through the P&L as share-based payments versus operating expenses. If we strip those numbers out and we look at it from a like perspective, EBITDA would have been up 8%, and our EBITDA margin would be in line with the prior year. Our cash balance at the end of June was 5.2 million, which was up $1 million on the half year result, which is really fantastic. And if I go back to where we were at the end of FY23, it was 4.7 million. During that period of time, we also paid $100,000 off our debt facility, which we now have principal payments of $50,000 each quarter. So we're pretty excited to be paying off that loan. I think it's a really good milestone for us as an organisation to be servicing and paying off some principal debt as well. And that operating cash flow for the full year was $3.5 million positive. So that's fantastic. Other things to sort of note about the full year. Our gross margin, and you'll see those numbers when we put out the audited results at the end of August, is actually improved by 1% during the financial year. So the cost of servicing revenue had improved over the financial year, and that's related to growing our panels, which allows us to improve our margin from that perspective, and then also procuring third-party panel at more favourable pricing. So we worked really hard on improving the rates that we purchase any third-party panel at. Little thing about just the investments. We talked a little bit about the investments we made during FY24, and I just want to talk to them again. So clearly headcount outside of Australia. In fact, we have hired 8 new salespeople throughout the financial year, a couple in Southeast Asia and Indonesia and Singapore. We hired some new people in Portugal and Germany. We hired a partnerships manager in the UK, which will be helping us seek new partnerships in the US and the UK, some sales support roles, and then operations roles throughout the year. We also went through our ISO 27001 accreditation during FY24. And that added some additional investments into the business, which is, will help us from a commercial perspective. A lot of government clients and a lot of clients typically now want you to have that international IT standard accreditation, obviously with a lot of the cyber breaches that have been going on and sort of the heightened, thinking around that at the moment. So for us, it's a commercial investment, obviously, helps de-risk the business from a cybersecurity perspective as well. So that was other investments we've made. And if any of you are following us on LinkedIn, you'll notice that we have been attending quite a few marketing conferences, Quirks in New York. We went to conferences in Thailand, etc. And that's really helping us grow our rest of world revenue as well. So fantastic result for the full year. As I said, we're really thrilled with how we sort of finished the year off in Q4. If you go to the next slide, I'm not going to go through this in too much detail, but again, just very similar trends. You can see the 3-year compound annual growth rates for each of the different metrics here. And obviously the other thing that I didn't really point out was the platform revenue actually had an amazing outcome in FY24, 88% up. So similar growth rates that we've been seeing for the last couple of years, and getting up to $10 million. So quite a significant chunk of our overall revenue now, which is really pleasing as well. We just want to go on to the quarterly slide. So as I said, really exciting, $13.1 million for the full quarter, which was 18% up. That was the strongest growth that we've seen for the full financial year. Q3, we only had revenue growth of 6%. Q3 is obviously also a seasonally slower quarter for us. The ANZ business really bounced back and had a really strong recovery in performance, which was 7% up year on year, and a really strong result for the rest of the world, 38% up. And we really did see really strong growth in the US, the UK, and in India throughout the quarter. Pleasingly, EBITDA, even if you include the impact of the STI in Q4, was up 13%. And then if you actually pull out and do a like-for-like comparison, that's 23% up. So we did have a really strong end to the financial year in Q4, and our platform revenue was 59% up at 2.5 million. So it's on a run rate of $10 million at the moment from that perspective. And our EBITDA margin, if you exclude the STI, cash STI, was 1% up. So that's fantastic. And then I've just also put in if you go to the next slide, just the quarterly trends that are very similar to what you've seen. And as I said, EBITDA for Q4 was a really strong result for the business. So I think that's all of my slides, and I think Martin will just wrap up. Yeah.
Brilliant, Mel. Thank you very much indeed. And I think a couple of things, on Q4, as Mel finished with, that's momentum that we see carrying on into Q1, and as that growth rate that we've seen there and the numbers that we've seen there give us momentum for the year. So really exciting about that as a business too. So what are our key priorities for 25? Well, at a very high level, it's continuing to be a growth organization, so that 10% plus at a top line revenue, and continuing to see EBITDA margin expansion, so doing what we do better and more efficiently, and now continuing to see that growth of our NPAT positivity. So that's the three headlines. How are we going to do that? International expansion. So as I talked about earlier, we've got the new Spanish and German offices to see those grow out, really grow out the UK commercial team, and 25 is the year of growing out that UK business. So we look to rest of the world, currently said 43.5% of our revenue, seeing that during the year hopefully expand to over 50% of our revenue. ANZ, maintaining and growing on that momentum in Q4. We're market leaders as a business. So again, looking at new solutions into the marketplace, how we can win new clients and grow our existing base. A big part of that is that iLink acquisition, helping that Australian business already to bring in more market share, more clients, 17 new people, and a couple of exciting new software solutions as well. So integrating that, growing out that revenue, growing out the profitability for both businesses. Then to see that data and panelist growth continue, Mel touched on, we've now got somebody in the UK heading up partnerships. During the year, we had 2 new exciting partnerships, financial business in the UK called Sprive. That's towards April, May time. We're now seeing audience numbers come through that. That's a really strong partnership, and the first one that we've had overseas in the UK market. So growing out Sprive and then using that as a test case and reference for more clients. And then we had a new partnership in New Zealand as well, called Horizon, and again in the New Zealand market, helping us grow out those data points and the partnership there. So continuing to grow out our panelists around the world. Technology improvements, it's a real focus now about external client solutions, whether it's generative AI based or it's just the innovation mindset that comes from being able to do things, development work faster, and again ticking those 3 boxes of how can we do things faster, how can we do things cheaper, more efficiently, and how can we improve quality. So it's around launching technology solutions that do those 3 things. Focus, again, as I said at the beginning, on that impact profitability. There are very few microcap businesses that are also impact profitable, that are growing at the top line, that are having the investment that we're able to put in to grow around the world that we do. So it's maintaining that and growing out that. And then really looking at beyond financial year 25 and how we then the next real area for us to grow in is the US market over 25 and how we hit the revenues. And towards, I think, the end of October, we'll have our AGM. We'll give out guidance again, or traditionally as we've given out guidance at our AGM. And again, really pleased we hit the guidance that we gave. And so we can really set the scene at our AGM for the industry, for also us as a business, for shareholders, and how we're going to grow that in 25, 26 and beyond. So keep doing what we're doing, keep saying what we're doing and writing on the tin every time. That's what we're going to achieve. And guess what? We achieve that as a business. So in summary, going to keep saying it because we're proud of it. We delivered a full year positive net profit after tax of 107,000, as Mel talked about. Revenue was up 10% on PCP, which is fantastic. Q4 was a record quarter for us as a business. Actually, within Q4, May was the highest revenue month we've ever had in 24 years as a business. In our UK, US and EU businesses, it was a record month for them also, and they've broken an important revenue milestone. We delivered a record number of projects and a record number of clients and a record number of panelists doing a record number of completes. So we really are hitting milestone after milestone. Rest of the world revenue up 23% year over year. Strong growth in UK and India being a focus. That's where we've put the investment. We're seeing that pay off. Putting more cash into the bank, so 5.2 million as a cash balance gives us the opportunity to potentially look at other acquisitions like iLink that give us a strategic growth in markets, could be UK, could be US and markets outside of Australia. And then we completed our first acquisition as this leadership team in the last 4 years, and to, again, as a business, learn a lot from doing that. Great acquisition, and is that giving us a template to do others within the ability, the cash that we have at the moment. So that's the summary. Really pleased to be able to present this result, and as Mel said, is hats off to everybody in the business, all of our stakeholders that have enabled us to do that. And so with that, I'm going to hand back to Jane.
Thanks, Martin. Thanks, Mel. So with that, I will now open up the floor to Q&A. Thank you to everybody that's already popped a question into the Q&A function at the bottom of the screen. We've got quite a lot to get through, but if you do have one, now's the time to pop it in. So we might start with this one. So comparing Pureprofile's direct to customer SaaS platform to your competitors, what are technological aspects or products, in addition to Audience Builder, Audience Intelligence, and Insights Builder, that Pureprofile still needs to invest in?
Yeah, that's a really good question. And it comes back to that earlier slide that I talked about. the area that we're focusing on now is actually having client-facing, a brand-facing solution. So a lot of the work that we do at the moment is with data and insights agencies, research agencies, AI technology companies, and it's about opening up new revenue streams with end user clients in mind, doing much more work with brands that we do at the moment. So those are solutions thinking about front end usability and the way I can interact with Pureprofile easily, upload maybe creatives that I want to be analyzed by audiences, upload text that I want to be analyzed by audience to give business answers, and then that reporting end at the back end. So that's particularly a focus that we have at the moment. And I would hope in Q1, as we are, that we will start to announce some new solutions to the industry in the marketplace that we're bringing out and that we've been working on for the last 12 months or so.
Great, thanks, Martin. A couple of questions here, perhaps for Mel. So what level of share-based payments are expected in FY25, and what was the number in FY24?
Okay, so we booked through the P&L in FY24 $950,000 worth of share-based payments. We still have some plans that are vesting over a number of years, predominantly long-term incentive programs that were put in place a couple of years ago. Typically, those plans have vested over 3 years, so we still are running through a couple of those. And there's a couple of other smaller plans that we have for our senior, I suppose, our high performers in the organisation. And we also provide a small amount of shares to all new employees when they have passed their probation, as ensuring that all of our team are incentivized. So going into FY25, you will continue to see a reduction in those share-based payments. We're expecting it'll probably be around about $400,000 for the year. So going down from $950 this year in FY24 down to another further down to $400,000 at this point in time.
Thanks, Mel. Okay, another question for you. Do you expect finance cost savings with the new facility, and if so, what quantum?
Yeah. So when we got the new facility in place in last financial, well, it was December this year. December 20 at the end of FY20, 2023. We actually didn't get savings in interest rates. The facility that was put in place from FY20 was around about 8.5%, the original facility that we had with Lucerne, which was then novated over to Altor Capital. Obviously, interest rates had moved significantly since 2020 when that first facility was in place. So when we went to look at new funding arrangements, and we've obviously announced that we have now moved to a Big Four bank with CBA, the interest rate that we're paying equates to around about 8.5%. So there's no significant change. If we'd stayed with a funder similar to Altor, a debt fund, we would have been expecting to pay between 13 and 15% if we'd secured a facility in that same time frame. That said, now we are paying down some of the principal. That will start to obviously mean that the interest expense will start to come down. As I said, the payments are about $50,000 per quarter. So that means at the end of the 3-year facility, we'll have paid down about $600,000 of the $3 million loan. So that should bring that cost down. So I think the point is if we hadn't secured the funding through CBA, the finance expense would have gone up significantly. So that was a real a real success thing for us to secure that type of facility.
Terrific. Well done. Always good to see that principal coming down. Okay, it's going to stick with you, Mel, because there are a couple of other sort of questions here on the finance side. And I've got two here that are sort of similar, so I'm going to group them. So going forward, what percentage of gross profit can hit the EBITDA? And then how has the gross margin been? Is it about flat through the period and likely to stay around this level going into FY25, including iLink?
Great question. As I sort of mentioned when I went through the full year result our gross margin actually improved by 1 percentage point. Obviously, the gross profit grows as the revenue grows, and we obviously want to try and reduce our cost of sales on every dollar of revenue that we write. And there's a number of ways we can do that. So we can build our own audiences through building our own panels or doing more partnerships. And they're two key things that we've been, key focus areas for us. Martin talked about some of the new partnerships that we've had, such as Sprive and Horizon in New Zealand. That'll help us to improve that margin over time. And then the next thing that we can do also, which is getting a lot easier to do as we get scale, is reduce and negotiate better pricing when we do have to go buy third-party panels. So one of the key suppliers that we buy from, we've secured some quite favourable favourable pricing from them. Interestingly, it is a small supplier that iLink uses them as well, and so that'll actually improve their profitability even further as well. iLink is a slightly higher gross margin than what Pureprofile has. It doesn't use a lot of third-party panel because it has its own panel, and obviously, I think we talked about $2.7 million worth of revenue that they did in FY24. So that will help, obviously, our gross margin going into FY25. We certainly will be doing what we can to hold gross margin as the revenue continues to grow outside of Australia, and ahead of the growth in those panels outside of the region or the partnerships. That does mean that we have to fulfill a lot of that revenue with third-party panel. So we sort of look at all the levers we can. We certainly don't want to see gross margin going backwards. And so that is really a key focus area for us as a business, is to make sure that we have those partnerships in place to get us to obviously improve that margin from that perspective.
Thanks, Mel. Okay, couple for you, Martin, now. One of which you've touched on with a particular slide, but despite the good result, why is the share price not moving?
A great question. When we continually speak to our funds, shareholders, get feedback regarding that element of our business as we talk to clients regarding our internal business. But it was around seeing that margin expansion continue, seeing growth continue, and being NPAT positive. And there, again, being able now to go out with that story, all of those elements of a growth business, hopefully we'll be able to create more demand for the shares, bring in new funds to support the existing funds that we have on the business and increase that demand level. It is a great story, and it's now about getting that great story out to the markets and see that response, and the companies and individuals are looking for secure value-based investment, and I believe that's Pureprofile.
Thank you. I would add to that from an investor relations perspective that the last 18 months of the market's been very difficult and challenging, but in the last couple of months we're starting to see that sentiment improve. So I think hopefully with an improved market coupled with that really strong fundamental position, we should be in good stead to go out and tell that story well. Okay, so back to you again, Martin. Could you give us a sense of the repeatability of platform revenues? Are you seeing a transfer of existing clients into the platform, or is it mostly new clients?
Yeah, good question. Look, overall, that 91% of repeatability for client revenue is consistent across all elements of our business. I think the platform revenue does three different things for us. Not in any particular order, but one is it's a fuel for our existing data and insights business. So by having that platform revenue, we can do more work with more clients and increase our overall data and insights. Number two is it helps to increase our margins. It's a lower cost way of us delivering faster, recruiting quicker panelists to deliver that revenue. And then the third one is it brings on new clients that only want to work in a DIY type environment as opposed to working with an account manager. So we see those three areas for us as platform and how it complements each area of the business for us.
Great. Okay. I'm conscious we're just about at the time that we'd promised people we'd keep to. We've got 4 questions left in the channel. I'll work through those quickly, and then we'll wrap up. So where do we, excuse me, where do we sit with some of the partnerships that were signed some time ago and plans for the future, e.g. Asian Parent?
Yeah, look, it's an absolute focus for us rolling out new partnerships, and we talked about Sprive and Horizon and growing out those partnerships in the UK to give us a critical mass, more panelists, and more data and insights. All partnerships perform differently, so us being able to offer across Southeast Asia, being experts with parents and young children is a big part of delivering revenue for us. So it's an important partnership. New ones that we had in 24 and end of 23, Shopback in Australia is a great one for us. Flybuys continues to be a great partnership for us also, and then new ones we're adding. So yes, it's nurturing existing ones, growing new ones with a focus on UK and US ones moving forward.
Thank you. Okay, Mel, back to you. CapEx in FY25?
Yeah, so CapEx for 24 was about 2.2 million. It was actually slightly down on the prior year, which was about 2.3 million. I'm not expecting any significant change in CapEx for 25. So you'd expect it's going to hover around the 2.2, 2.3, 2.3 million level. We're not hiring loads of new engineers to build new things. What we've been doing is, as we get efficiencies, even out of using AI with the way that the engineers work, that allows us to get efficiencies and be able to roll out more new products, services and features for our clients within the same sort of CapEx envelope that we've had over the last couple of years. So that CapEx number has been relatively flat for the last couple of years. And we have no intention of, radically changing that at this point in time.
Great, thanks, Mel. I will couple these last 2 questions. So we did speak briefly about share-based payments, but a couple more here. So are share-based payments being phased out? And then there's been a lot of hiring this financial year, which is understandable given the growth aspirations, which you just mentioned. Given this and other changes such as share-based payments, what can we expect for operating leverage in the coming year or 2?
Okay, so the first one, the share-based payments. So there still are, as I said, plans that are in train over another 2 years. So they obviously will come down over time. We didn't have any long-term incentive program for any of our senior executives in 24. It's unlikely we won't have one again in FY25. I don't really want to comment on what could happen in the future. I'm not sure about from that perspective, but certainly we won't see any significant change in share-based payments or any new plans, probably typically what you might have seen in the past. The short-term incentive program now can be funded out of operating cash flow, so there will be no equity programs for short-term incentives, similar to what we might have had in the past when we were trying to conserve cash. We are now obviously quite strongly cash flow positive from an operating perspective, so we can fund that moving forward, and that's the intention going into FY25 from that perspective. So in some respects, yes, definitely being phased out by not having all of our incentive programs being equity based and obviously having that dilutive impact on our shareholders. That's obviously something we're incredibly mindful of.
Yeah. Okay. Thanks, Mel. Martin, we've gotten through quite a lot of questions. I will hand back to you for any closing comments.
Yeah, look, it's great, and I think the questions were fantastic, and all of those questions are areas we're really mindful of and we're really focusing on. And I'm delighted to see the progress we've done over the last 4 years. I'm delighted to see we hit additional milestones. The company goes from strength to strength, and now let's see it all reflected in the share price. And thank you for everybody who's joined, for the questions that we've had, and for the continued support in the business.
Excellent. Well, thanks to both of you for all your presentation and running through the Q&A today. Thanks to everyone for joining. With that, I will say we look forward to keeping you across Pureprofile's progress and invite you all now to disconnect. Thanks, everyone. Have a great day.